Hey everyone, in this video I go over chapter 2, the recording process. As you remember, we learned in chapter 1 that the definition of accounting includes 3 activities, 3 verbs: identifying, recording, and reporting or communicating. So in this chapter we have 4 learning objectives. We start by defining debits and credits and how they are used in recording our business transactions. Then we learn about a journal, what a journal is, and how it is used again in the recording process. So the journal and ledger are 2 books that we use to record our transactions, to classify and summarize our transactions. The journal is called the original book of entry. The ledger is called the secondary book of entry. So we use both of them to record our transactions. And at the end, in learning objective 4, we learn about trial balance. Trial balance is another tool in accounting process, in accounting cycle, that we use to record our transactions. Basically, trial balance summarizes everything. We record our day-to-day transactions into our journal, and then we categorize our transactions based on their accounts in the ledger. And in trial balance, we summarize all the ending balances of each account. So what does debit or credit mean in accounting? Well, they have nothing to do with debit cards or credit cards or any other banking related activities. In accounting, debit simply means left. Credit simply means right. Left and right, as simple as that. So debit is equivalent to the term left in accounting, and credit is equivalent to the term right. Nothing more, nothing less. But you may ask, okay, I understand, left and right, easy. But left and right of what? Left and right of an account. So let's go ahead and see what an account is and how it looks like. Accounts are places that we record our financial transactions in. So this T-shape is a form that we use to represent an account when we are learning accounting. We really don't use it in practice, but when we are learning accounting, we use this T-shape to represent an account. So we have several types of accounts. As you remember from chapter 1, assets, liabilities, equities, revenues, and expenses. And within each group, we might have hundreds of accounts. So account groups, for example, assets. We may have cash inside it. We may have like accounts receivables. We may have inventory. We may have supplies. We may have fixed assets, and so on and so forth. So each of these accounts can be shown using a T account, okay? But back to debit and credit. So the left side of this T is called debit. The right side of this T is called credit. And then as we analyze transactions, different numbers, different amounts could go either to the left side or to the right side. We will learn how that works. But for now, I want you to just have a good understanding of the form of a T account and the idea of debit and credit. So we put numbers on the left or right side of a T account, and at the end of the period, at the end of the year, at the end of the quarter or a month, we go ahead and calculate the ending balance. Ending balance could be on the right side, on the credit side, or on the left side. One side, not both, so only one side. Again, in a second, we will learn how to calculate these ending balances. But for now, this is a T account, and this is how we show it. So I told you that sometimes when we analyze a transaction, when we want to record it, the amount could go to the right side or to the left side. How does that work? Right off the bat, I want you to remember that debit does not mean increase, or debit does not mean decrease. as well as credit. They just mean left and right. If a transaction leads to an increase in an asset account, then we put that amount on the left side of the T account. So if I collect money, if I sell something, receive cash, cash is an asset, so cash goes up, I put that amount on the left side of the cash account. Similarly, if I pay cash to purchase something, I lose money, I'm giving up my money, my cash goes down, I put that number on the right side of the cash account. So debit side increases asset accounts. It decreases liabilities. Debit also decreases equities. It also decreases revenues. How about expenses? So based on the color coding, you guessed it. When expenses go up, we debit them. We put the amount on the debit side of the account. Credit is just the opposite of the debit. So if liabilities go up, we credit them. We put the amount on the right side. This is how debit and credit work in accounting. Okay, as simple as that. But there is an extremely important concept in accounting, the idea of normal balance. Normal balance is the side that increases the balance of the account. Normal balance of an asset account is debit. Normal balance of a liability account, like accounts payable, is credit. Normal balance of an expense, like utility expenses, is debit. Once again, the normal balance is the side, either left or right, either debit or credit, is the side that increases the balance of an account. Let's go ahead and quickly review everything about learning objective 1. Debit means left, credit means right, and we use debit and credit to show the increase and decrease of specific accounts. Again, debit does not necessarily mean increase, debit does not necessarily mean decrease. It depends. It depends on the account. For assets, debit means increase. For liabilities, debit means decrease. And of course, T account is a form that we use to illustrate, to show the idea of an account. Accounts are like containers in your kitchen. You use different containers and you put them into different cabinets. You may think of containers as accounts and those cabinets and drawers as account groups. The next topic is called double entry system. And the idea is that for every single transaction, at least 2 accounts are involved. At least 2 accounts are affected. And they are affecting in a way that accounting equation remains in balance. Remember accounting equation? Assets, total assets equal liabilities plus equities. And within each group, we have several accounts, right? Within each account group, we have several accounts. So a transaction could affect any of the accounts, but there must be at least 2 accounts changed. And that change should keep the equation in balance. Another thing is that for every single transaction that we record, there must be at least 1 account to be credited and 1 account to be debited. And of course, the summation of debits should be equal to the summation of credits. Debit balances and credit balances. So let's take a look at this T account here. It is left with a balance at the left side, debit side. We call it a debit balance. What does make a debit balance? So to calculate the ending balances, we need to sum up all the amounts on the left side. In this case, $10,000 plus $8,000, $18,000. We need to sum up all the amounts on the left side and sum up all the amounts on the right side. Okay. Take the difference. And the difference goes to the side with a higher summation. So here 18 is more than 3, of course, and the difference goes to that side. This is how we calculate the ending balance. In this case, since the left side is bigger than the right side, we are left with a debit balance. Some accounts may have credit balances. The calculation, the idea is the same. We sum up all the amounts on the left side. We sum up all the amounts on the right side. So in this case, it is 10K. On the right, we have 11K. We take the difference. In this case, it is -1. We forget about the sign. We take the absolute amount. And the difference goes to the side with a higher summation. This is how we calculate ending balances per account. So let's briefly review the normal balances of different account groups. Assets, they have normal balance of debit. Liabilities, their normal balance is credit. And of course, normal balance is the side that increases the balance. Normal balance is on the increase side. For equities, the normal balance is credit. And again, back to accounting equation, liabilities plus equities. Equity could be decomposed into its components, right? If you remember, common stock plus retained earnings. So common stock and retained earnings are equities, actually. They are not account groups, they are accounts within the group of equities. They follow their parent. Their normal balance is credit as well. But the only exception is dividend. Dividend is the bad child. It doesn't follow the normal balance of the family. Its normal balance is actually debit. So that's the only exception. Remember that. Revenues, normal balance is similar to liabilities and equities. It's credit. And expenses, normal balance is debit. So revenues increase equity. Expenses decrease equity. Again, if you remember back to accounting equation, assets equal to liabilities plus equities, I'm going to decompose it into its components, like common stock plus retained earnings. And then retained earnings could also be decomposed into its own components, like revenues minus expenses minus dividends. So this is very important. Take a look. Expenses have a negative sign, right? So if we increase expenses due to this negative sign here, it eventually decreases equities. Expenses have an opposite effect on stockholders' equity compared to revenues. Revenues have a positive sign. So when revenues go up, they basically increase equities. So this slide summarizes all the normal balances. Debits on the left and credit on the right side of the slide. But we learned in chapter 1 that financial statements are interrelated, right? This slide shows how equity components are related with each other and how we can use them in different financial statements. For example, as you can see, as we learned, equity includes common stock and retained earnings. Okay, common stock is the amounts that investors put into the company, the invested money by investors, and retained earning is the money that we generate, we make inside our company, and we keep it inside the company. So what is the money that we make in the company? You take your revenues, you deduct your expenses. It is called net income or net loss. If expenses are more than revenue, that would be loss. The net income is the money that you made in your company. Okay. You take that net income and you put it into the retained earnings statement. And after deducting dividends, you are left with ending retained earnings. Ending retained earnings go to balance sheet. That's how we calculate retained earnings. Okay, so this is how different financial statements are related with each other and how equity components are related with each other. So I told you that I will give you a hint to remember normal balances easier. So here it is. We learned that balance sheet includes assets on the left side, liabilities and equities on the right side, and balance sheet is basically our accounting equation. assets equal liabilities plus equities. Again, assets are what we own, what we have, and we are able to use them to benefit from them in the future. Liabilities are what we owe, and equities are investors' claim, basically what they put into the company as the first initial investment, as well as the money that we made in our company. So that's our balance sheet. In income statement, we take revenues and we deduct expenses. The result is net income. Of course, if expenses are more than revenues, that negative amount will be called net loss. So here the formula is revenues minus expenses. We are left with net income if revenue is more than expenses. But if revenues are less than expenses, then it will be called net loss. Okay, so that was just a quick review of balance sheet and income statement format. But take a look. The balance sheet in this slide is quite similar to a T account, right? There is a left side, there is a right side, and assets are on the left side, liabilities and equities are on the right side. And in accounting, left means debit, right means credit, right? So using this slide, I can easily remember that assets normal balance is debit and liabilities and equities normal balance is credit. Again, since revenue is the money that we earn, it increases the equity, so their normal balance is similar to equity credit, and expenses work the other way around. They decreases equity, so their normal balance is debit. So hopefully this slide will give you a better understanding of the idea of debit and credit and why normal balances are different in different accounts. So in learning objective 2, we learn about the journal and how we can use this tool in our recording process. So the recording process has 3 steps. We start by analyzing our transaction, and then we record our transactions in journal, and then we transfer the information in the journal into ledger or ledger accounts. At this point, by learning the idea of normal balance and concepts of debit and credit, we should be able to analyze a transaction very well. Then the next step is to learn how to journalize a transaction and record it into our journal. And of course, the next step would be to transfer, to post information from journal to ledger and ledger accounts. So what is a journal? As I told you in the beginning of the video, the journal is also called the book of original entry. It is basically just a sheet with different columns. Okay, the first column is always date, then account names, and then debit and credit. And then we record each transactions one after the other on this sheet. Okay, the order matters. The order is actually based on the date of transaction. We say the journal is recorded using a chronological order. So the journal gives us a chronological record, meaning different lines are recorded based on their time, the time of the activity, the time of the transaction. Today's transaction goes first, tomorrow's transaction goes next, the day after tomorrow's transaction goes next and next and next. It is called chronological order. And that's it. It is our journal. It is a sheet that shows all the transactions one after the other. So let's see how it works with an example. You are going to journalize a transaction. Journalizing means to enter transaction data in the journal sheet. So on September 1st, stockholders invested $15,000 cash in the company in exchange for stock, and the company purchased computer equipment for $7,000 cash. At this point, I see 2 transactions. The first one is an investment, $15,000 cash invested amount in exchange for shares, and the second one is a purchase of equipment $7,000 cash. So I see two transactions. I go one by one and journalize them. And this is basically the most important part of the recording process: to read the transaction, to analyze it, and to take 3 steps. Step 1, identify your accounts. What accounts are involved? What accounts are changed? So in the first activity, in the first transaction, stockholders have invested $15,000 cash in exchange for stock. So the first account, of course, is cash, which is an asset account. And the second account is stock or common stock. So step 1, 2 accounts are identified. Step 2, identify which account is increased, which account is decreased. So here we have received some money. They invested in the company, so we received some cash. Cash went up, cash is increased. How about common stock? Is it increased or decreased? Well, to answer to that question, we need to know the definition of common stock. Common stock account shows how much money is invested by investors. The actual money is in our bank account, is recorded in the cash account, but common stock is just a simple record showing that investors put money in our company. In this case, they are putting $15,000. So after this transaction, investors can claim $15,000 against our assets. So common stock also goes up. That was step 2. Step 3 is to translate increase and decrease into debit and credit. How do we do that? We need to use the concept of normal balance. So using the idea of normal balance, we can easily translate increase and decrease into debit and credit. So cash is an asset account when it is increased, meaning we need to go with the normal balance. It is debited because assets normal balance is debit. Common stock, it is increased here. Again, we need to go with the normal balance. The normal balance of common stock is credit, so we credit it. As soon as we are done with these 3 steps, we are ready to do the journalization. But before we do that, let me read the second transaction. Step 1, what accounts are involved? What's going on here? We are purchasing a computer for $7,000 cash. Of course, cash is one of the accounts that is changed. Something else is also changed. What? Computer or equipment. So 2 accounts are identified. So we have purchased something and we paid cash. So we gave up our cash. Our money is decreased. But in exchange of that cash, we have received a new computer. So equipment is now higher. We have more equipment in our company. So it goes up. It is increased. Step 3, to translate increase and decrease into debit and credit. Cash is easy, right? Cash is an asset. Its normal balance is debit. Here it is decreased, so we don't need to go with the normal balance. We go with the opposite of normal balance because it is decreased. Again, normal balance is the side that increases the balance. Equipment is also an asset. In this case, it is increased, so we go with the normal balance. Normal balance of asset is debit. Let's see how we can journalize them. This is an example of a journal here. The first column is date because the order is date. Second column contains the name of accounts. And we do have, forget about the reference for now, we do have debit and credit columns on the right side. So the first one was cash and common stock. Cash was increased, it's an asset, so we debit it. Common stock is also increased, but it is a liability, so we credit it because its normal balance is credit. For the second transaction, equipment is up, is increased, so we debit it, and cash, we have lost our money, we have given up our money in exchange for equipment, so it is decreased. So why it is credited? Because normal balance of cash is debit, and normal balance always represent the increased side. So here, since our cash is decreased, we go against normal balance, go with credit. See how it works? As easy as that. But sometimes we have more than one account affected by one single transaction. In that case, the journal entry would be called compound entry. So here we are purchasing a delivery truck. The price is $14,000, but we pay only $8,000 cash and agrees to pay the remaining $6,000 on account. On account is an important term in accounting. It means cash was not involved, cash was not paid, or cash was not received. Cash was not involved. Instead, we promised to pay later. In the case of purchasing, or in the case of selling something, we accepted the promise of customer to give us money later. This is very important. We do not need to receive everything in cash or to pay everything in cash. We can just accept a promise related to a payment in the future. So in this case, let's see how we can journalize it. Again, the format of the journal is the same, but accounts are cash, of course. How much? Only $8,000, because that's all we had at the time and that's all we paid to purchase that truck. Why it is credited? Because we have purchased something. When we purchase something cash goes down. When cash goes down, cash is an asset account. The decrease of an asset account is the opposite side of its normal balance, which is the credit here. The second account is equipment or the truck. How much? The cost, the total cost, $14,000. Why it is debited? Because equipment is an asset account. We have purchased, we have added a new piece of equipment to our company. So assets went up. When asset goes up, we use the normal balance side, which is debit. But 8,000 here, 14,000 here, we are not in balance. Our transaction is not in balance. We need a third account. That account is accounts payable. This is basically our promise to pay later. This is an account that we use when we promise to pay later. How much? The remaining $6,000. Why it is credited here? Because accounts payable is a liability account. And liabilities normal balance is credit. So here, since we are promising to pay in the future, before this transaction, we had no promise to pay to anyone. But after this transaction, now we have increased the amount of our promises. So we increase the amount in our accounts payable. In learning objective 3, we talk about the ledger. So take a look at the diagram at the bottom of the slide. We passed the analysis phase, we passed the journalization. Now it is time to post the journal information into our ledger. But what is the ledger? The ledger is simply the same as journal. It contains all the information, but information is categorized based on different account names. Remember, in the journal, the order was time. It was a chronological book, right? But here, the order is basically account names, starting with assets and then liabilities and then equities. So this is an example of a ledger account. In this case, we are using the cash as an example. Let's take a look at the format of the ledger. Of course, the first column is date, then the explanation. What is this transaction for? Forget the reference for now. And then debit credit. And then we do have a new column here called balance. This is a moving balance. It's a rolling balance. It changes based on each transaction as we move on. So initially we didn't have any balance, and then we debited cash $25,000. So our balance went up $25,000. And then we credited cash $8,000. Remember, for cash, which is an asset account, debit means increase, credit means decrease, right? So when we credit 8,000, we are decreasing our previous balance by $8,000. So the new balance is now $17,000. 25 minus 8, 17. Then we go ahead and debit our cash account again on June 3rd, 4,200. We are debiting, it increases our balance. So our previous balance, $17,000, now is increased to 21,200. Basically previous balance, this time plus the new amount is now equal to 21,200. And so on and so forth. It goes down all the way to the end of the period. But what is posting? To post or to transfer information from our journal to our ledger account is basically just copying and pasting, but in a specific order. For example, here in our journal, we have cash account and common stock account. Okay, these two accounts are changed. Cash is changed $15,000. It is increased. How do I know that? Because cash is an asset, and asset's normal balance is debit. It is debited, so it is increased. Common stock is increased $15,000. Again, how do I know that? Because common stock's normal balance is credit. It is credited here, so it is increased. Let's transfer this information to their related ledger accounts. Step 1, transfer dates. We put date into related ledger accounts. Step 2, remember those reference columns that I skipped previously? Here we are going to use them. Step 2, put the number of cash ledger account in front of the cash account on your journal. Step 3, transfer the amounts. Transfer the amount. So $15,000 goes to the debit side. It is the same for the common stock. Date is transferred, and the amount is also from journal is transferred to ledger. As simple as that. What about the reference column in our ledger accounts? Well, they contain the page number of our journal, because our journal could have several pages. So this process is called posting. Chart of accounts is basically a list of all the accounts you use in your company. It usually starts with the asset accounts, and then it goes down to liabilities, equities, revenues, and it ends with expenses. We call this order the order of financial statements. Okay, because as you remember, assets, liabilities, and equities, they are balance sheet accounts. Revenues and expenses, they are income statement accounts. So let's see another example here, from reading a transaction, analyzing it, to journalizing it, and to posting the information to its related journal. So let's read the transaction. On October 1st, the company purchases equipment costing $5,000 by signing a 3-month 12% $5,000 note payable. Okay, let's analyze it. What's going on? We are purchasing something. What thing? Piece of equipment. How much is that? $5,000. How am I paying for this purchase? Am I paying in cash? No, I'm not. So I'm signing something. What is that thing? A note payable. So my first account is actually here, equipment. I don't need to be worried about the information, the details here. I just need to know that my second account is notes payable. This is how I am affording the equipment. I'm paying for the equipment. I'm basically promising to pay in the future by signing a note. So equipment is increased because we purchased a new piece of equipment, and liabilities are also increased because before this transaction we were not liable to pay anything to anyone. We had not promised to anyone, but due to this transaction we have a new promise to pay. It is increased. Notes payable are liabilities. Again, at this point you may not really have a good idea about types of different accounts. The only solution is to, at this point, to go and read your chart of accounts. So as you can see, notes payable are here and they are liabilities. As you practice more and more, you will learn more about different types of different accounts. So after the analysis, we go ahead and see how this transaction affects our accounting equation. Equipment is an asset, it is increased, so the left side of the equation is increased. On the other hand, liabilities are also increased, so the right side of the equation is also increased, so the accounting equation remains in balance. Next step is to translate increase and decrease into debit and credit. How do we do that? We have to use the concept of normal balance. Normal balance is the side that increases the account. In this case, both accounts are increased. So what is the normal balance of asset? It is debit. So we debit equipment. What is the normal balance of a note payable? It is a liability. Its normal balance is credit. So it is credit that increases the liability. So we credit notes payable $5,000. Now we are ready to journalize our transaction. Remember, always, 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 first go with the account which is debited. In this case, it is equipment. And then go with the credit account. So we debit equipment 5,000, we credit notes payable 5,000. Now we can post this transaction into their related ledger accounts, equipment account and notes payable. Hey, aren't they familiar? They are basically RT accounts, right? So ledger accounts are basically RT accounts. How do we do that? Transfer dates first into related ledger accounts, and then we transfer the amount. Here 5,000 is debited for the equipment, so we put it in the left side of the equipment account, and notes payable is credited in our journal, so we transfer this number to the credit side of its related T account. We also put the references back and forth into the reference column. Here our ledgers do not contain the reference of our journal in this example. So other transactions will work the same. For example, in this case, we are paying office rent in cash, $900. So at the end of the month, we are left with a list of transactions ordered based on their date, and that list is called journal. Of course, the left side, the debit side, should always be equal to the summation of the right side. So these transactions, October 1st transactions, October 2nd, October 3rd, October 4th, all the way to end of the month, they are all listed here and they are posted to our ledger as well. So this is our general ledger sheet. It contains all the T accounts or the ledger accounts. This information is exactly the same as the information in our journal here. For example, cash on October 1st is debited 10,000 and is debited 1200 on October 2nd. So this information is transferred to ledger. Let's find it. Yes, on October 1st, debited 10,000, October 2nd, debited 1200. Do you see how it works? This is called posting. Transfer line of transactions from your journal to their related T accounts. But if you pay attention, you should notice something. Some numbers are in red. Do you see those numbers? Why these numbers are more important than the other numbers? So the answer is that because these are more important because these numbers are actually our ending balances. The ending balance is what we are really interested in because we use these numbers somewhere else. These numbers are numbers to be transferred to another document, which is called trial balance, which is the topic of our next learning objective. Learning objective 4, trial balance. The idea of trial balance is so simple. It is basically a list of all the accounts we use in our company with their ending balances. The balance which is reported at the end of the month on our ledger. Let's go ahead and take a look. So previously we saw that our cash was changed, increased, decreased, increase again at the end of the month. So the balance from 10,000 was increased and decreased, but the ending balance was 15,200. So we take that number and we put it in front of the cash account in our trial balance. We do the same for other accounts as well. Of course, the side is the same as the normal balance. So assets have a normal balance of debit, liabilities have normal balance of credit. So the balance should be reported on the correct side. But at the end, it is important to make sure that our left side and right side of our TB are the same. We use trial balance to prepare our financial statements. Remember, our goal in accounting, the definition of accounting was what? Analyzing, identifying transactions, recording transactions, and then reporting transactions or communicating transactions, right? This is accounting, financial accounting. The last step is to report, is to prepare financial statements. Okay, that's our end goal. So we use trial balance to prepare financial statements. See how it works? We are narrowing it down from lots of transactions reported in our journal to summarize them based on their account groups into our ledger, and then from ledger to basically one sheet which is called trial balance. And now we can use trial balance to prepare our financial statements. So all the transactions can be summarized into just 4 statements: balance sheet, income statement, retained earnings statement, and cash flow statement. But trial balance is not perfect. We may see a balance in our trial balance. Let me go to the previous slide. Here, for example, these left and right side, the total of the left, total of the right are the same, but it doesn't mean necessarily that our job was right. We have done everything correctly. We may have done some mistakes, but our trial balance isn't showing it. For example, we may have missed a transaction. If a transaction is totally missed, our TB is still in balance, and it doesn't show that the transaction is missed. Or we may have missed posting a transaction to our ledger. Again, it doesn't lead to an imbalance TB. If we post a transaction twice, mistakenly, obviously, it doesn't make the TB imbalance. It still shows that left side is equal to the right side in your TB. Sometimes we are using incorrect accounts. The accounts are different. Yes, the accounts are wrong, account names. They're wrong, but the balance, the left side equal to the right side. So if the left side of your TB is equal to the right side of your TB, it doesn't necessarily mean that there is no mistake. We need to go over our transactions again and make sure that everything is right. Lastly, the last slide in this chapter, how to present. My friends, in accounting, the accuracy of your numbers, your calculations is as important as the way you present your numbers. Presentation matters too. Why? Because we need to follow our standards. We need to make sure that our reports are comparable among different firms. When we prepare our journals, ledgers, our TB, we really do not use dollar signs on every single amount, every single line. We really don't use dollar sign in journals and ledgers. But in our TB, we just use the first line to show the dollar sign. And when you see a number being double lined, it means that that number is a total amount.